Hello everyone, Justin with Deep Dive Stocks here, and today we're going to be diving into the Bollinger Bands. This is going to be the first video in a variety of videos covering some standard stock indicators where we kind of dive a little deeper into them, figure out what's going on underneath the hood, and then translate that into some actionable principles if we do end up using some of these indicators. Without further ado, let's go ahead and get started. So the Bollinger Bands are pretty straightforward, so we only have a few goals today to cover. The first is that we want to gain some familiarity with the Bollinger Bands, then we want to understand what the Bollinger Bands are measuring, and then from there I think it's going to be helpful if we slightly reconceptualize the Bollinger Bands in terms of applying them to our actual trading styles. The Bollinger Bands are designed for real-time use, so you can put them on any of your almost all brokerages or brokerage apps have the Bollinger Bands, and essentially it just compares the current price movement with the previous price movement, and it tells us if that price movement is likely or unlikely. And it does this by calculating the typical price and then the standard deviation of the price movement and telling us where we are in the mix of all of that. Now that might sound a little bit much at first, but as we go through it, I think you'll see that it's pretty intuitive and pretty straightforward. The designer of the Bollinger Bands tells us that it is the bare bones definition is it tells us when a stock is oversold or when a stock is overbought. And it does this by displaying displaying two bands, the upper band and the lower band. And it does this in relation to this average price. And then we have the upper band, which tells us if the price goes above this, it's overbought. And if the price goes below this, it's oversold. And I'm sure many of you have seen the Bollinger Bands before. It's pretty straightforward. So for instance, here we would see as the price peaks below the lower band, we would consider this oversold. And the expectation is that the price would then start to navigate upwards. That's part of what we're going to investigate today to see if that's a valid assumption. So, as usual, we're going to dive a little bit into the math, but please don't run away just yet. I promise it's not too difficult. Or, it looks difficult, it does. I think people in the market like making their math look difficult, but we're going to see that this is pretty straightforward statistics. We have three main equations. The first one is for the mean price, and that gives us that average price here, this line. So that tells us how to compute that average price. And the other two tell us how to compute the upper and the lower boundaries. And we're going to dig into each one of these equations next. The mean price equation just tells us the average price, which is the high plus the low plus the close, divided by 3. And then this fancy equation here tells us how far back we want to go in order to, how much data we want to include in the calculation of this average price. So if we set J equal to 1, then we only include if this is our current candle, it only includes one candle back. And conversely, if J is equal to 20, well then we include 20 candles back. And so that'll determine how much information or how much data we include in the calculation of our average price. Then we're going to see not too far from here how that affects the overall appearance of the Bollinger Bands. Because for instance, if we set J to only be equal to 2, we see that the average price moves around quite a bit because it's only including the last two candles, candle 1, candle 2, in the calculation of the average price. So because there's less data, there's more variability. Whereas if we calculate J to be rather large, say 20 or maybe even 50, we see that the movement of the average price is much smoother. because it takes more significant movement to move the average price because we have much larger data, historic data included in our calculations. So even massive movements of data from the average, like we see here, only moves the mean price ever so slightly. Because again, this data, 1, 2, 3, 4, 5, 6, 7, 8 candles, and if this is a J equals 50, well then 8 over 50 is only a small part of the overall data that is included in the calculation of the mean price. And we also see, noting for later, this affects the smoothness of the upper and the lower bands as well. So the take-home point for when we include how much data we include, how much past data we include in the current calculation, is that we get more sensitive to changes if we decrease J, but we get a lot more variability. Whereas if we increase J significantly, to 20 or 50, this is just random numbers, but we decrease our sensitivity, but we increase like the smoothness. We increase the overall efficacy of what the data is telling us. But then again, we note that the decrease in sensitivity, because we could have big price drops like we see here, and we see that overall nothing really changes because we're not quite as sensitive to the local or the current change in the data. So let's look at it with a little bit more detail. Suppose we have a 10 for our high on this candle, a close of 8, and then a low of 5. If we add these up and divide by 3, we get a 7.6. Let me change the color real quick. Here we have a high of 12, a close of 10, and a low of 6, and these are mostly just made up numbers. And this gives us a average value of 12 plus 10 plus 6 divided by 3, and that's 6. And then here we have a high of 10, a low of 4, and a close of 5. And this gives us an average value of 6.33. So if we wanted to calculate what the current average price is, we would simply add these three up and then divide by 3. So we get 7.6 plus 6 plus 6.3 divided by 3, and that gives us 6.63. So the line, the median price line, would be probably right about 6, 3, 4, right around here. 6.63. And then if we wanted to calculate the average price for the candle or for this before it, we would need the additional candle, which we obviously don't have. But that's how the average price is calculated. And the cool thing about the Bollinger Bands is it doesn't stop there. It takes the change in the price, or the variance, or the variability of how much this is changing, and then it puts it into a nice distribution curve. And so what we do is we take these average prices that we've calculated along the way, and we combine them and collect them, and we start figuring out what a distribution of those price movements looks like. What is the most common price movement and what is the least common price movement? And we collect all of that information and we put it into a nice normal distribution curve. And if this is your first time being introduced to a normal distribution curve, don't worry too much. The whole idea is that we can map out the probability of some event occurring and then look at the area underneath this curve to figure out we can look at the area underneath this curve to figure out what the actual probability of that event occurring was. So from there, the cool thing about the Bollinger Bands is we can then slice this probability curve to tell us, hey, I want to know what is 68% probable given the past data. What does this distribution tell us is the upper and the lower range if I want to know what is 68% probable. And these are the exact upper and lower bands that you see on the Bollinger Bands. And just like you can set how many past data you want to include in your calculations, you can set how wide you want the slice of the probability curve to be by setting the n value. And that tells us how wide or how acceptable our upper and lower bands are compared to the data that we currently have. So the wider we set the distribution curve, say we set it to where we want 95% of the expected price movement to be within the upper and the lower bands, well then any price that moves above or below these bands is only 5% likely. And that's pretty nifty. And in fact, we can set n, I think its usual value is 2, and we can determine what we want to be alerted to as unlikely price movement. If we set n equals to 1, well then we get that 68, that's what that number was supposed to be, 68% probability. So if any price moves above or below, above the upper or below the lower band, then we're looking at something that has a 32%, if I did my math right, probability of occurring. If we set n equal to 2, then we get that 95. So any price movement that is above or below those bands would only be 5% likely. And then lastly, we have 3, which is 99. So that means that if there's any price movement above or below those bands, that would only be 1% likely, given the past data. And we can see this in action when we look at the same interval, this is SPY, I think, and the J value is the same, so we're using the same past amount of data, but we change our N value, and we see that just like as we changed, if this was N equals 1, and then this was N equals 2, and then this was N equals 3, just as we're cutting wider and wider portions of this distribution curve, we make the bands wider and wider. Because when n equals 1, we get a lot of the price movement is outside of these bands because these price movements are 32% likely. Whereas if we set n equal to 2, we don't really get that much price movement outside of these bands because the price movement would have to be 5%, is only 5% likely to move beyond those bands because n equals 2 is 95% coverage. And then n equals 3 is 99%, so we would only see price movement above or below these bands for 1% probability. So the price movement that only has a 1% probability of occurring would move above or below these bands. So 99% of the time, we would expect to see the price between these two bands. And so that's what when we choose n, we're just choosing what we consider to be acceptable probabilities. Another thing worth mentioning is that regardless of how much past data you include or what your cut of the distribution curve is, the bandwidth will change depending on how much the price itself is moving. This is somewhat of an important concept, as we will see later. The idea is that if the previous price movement was very narrow, well then my band will start to get more narrow. Because I'm shrinking, the data that is included in this distribution is getting tighter and tighter, so my distribution curve gets tighter, so my band gets tighter. As I start seeing extreme or more wide price movements, we see that my band starts to widen as well. So the idea is that if the price movement is above that upper band, it is most likely overbought because it is statistically unlikely price movement. Whereas if the price is below the lower band, it is most likely oversold because, again, it is statistically unlikely price movement for the price to go that far low. But as we're going to see, this can have some weaknesses. But let's talk about the strengths first. There are some strengths of the Bollinger Bands, and the first strength is that it is a direct visualization of the likelihood of the current price action. We get to see, okay, this price is now above my n equals 2 Bollinger Band, which means that there was only a 5% likelihood that this price action was going to happen based on the data that I fed into the distribution curve. Another strength is that it is easy to modify and tailor to specific use cases, so you can quickly look at a stock to see if its price action is well within the probabilities or outside of the probabilities. And it is nice because it does give this nice statistical data in real time. We don't have to sit there and calculate this ourselves. We can just visualize it with the addition of the Bollinger Bands onto our brokerage account, whichever broker you use. The weakness, though, I think, is that this false association of probabilities and human intent. The idea that if the price action is unlikely, that it is associated with human intent. And we're gonna dig more into that later. But just, unlikely price movement may just be unlikely price movement. There may not be a component of being overbought or oversold associated with that, because the inclination or the association, the implicit association, is that if something is overbought, well, then the price is going to drop. If something is oversold, well, then the price is probably going to rise, because if it's oversold, that means people are going to stop selling, which means people are going to start buying. So there's this subtle association here that I don't actually think is good if you're going to use the Bollinger Bands. The other weakness is, it's like we said, it's strength, but it's sometimes too easy to modify. And this can lead to trader subjectivity, where you can modify the Bollinger Bands to fit whatever subconscious or very not subconscious price movement or idea that you want to see in the data to justify a trade that you are either in or about to enter. So this ability to modify both the amount of data that you include and how wide of a cut of the distribution curve can sometimes be a trader's demise, because you can then essentially find any configuration that fits the narrative that you want to fit. The other downside to the Bollinger Bands is it really does require some working knowledge of statistics to extract meaning out of. And this is mostly because I don't believe in the overbought, oversold methodologies. So this means that we have to understand what the Bollinger Bands are actually measuring, which means you got to know some statistics. And that's a bit of a weakness. The other weakness is that there is a component of the cart before the horse. We noticed before I mentioned that the overbought, oversold idea isn't the best, and I think this showcases that exactly. We see that the price became, quote unquote, overbought here. And so if we had this idea that the price was going to fall, we may short the stock, and we see that that would not have been a good financial decision. Additionally, we see that as the price rose, the average price rose as well. This rose the bands, and eventually the Bollinger Bands just came and met the price at where it was at, and now the price was no longer overbought, even though it is actually higher than it was when it first indicated being overbought. So here, I think, is a really good example of why the idea of overbought and oversold may not be the best when utilizing the Bollinger Bands, because the Bollinger Bands will naturally just move to the price if the price stays elevated a sufficiently long amount of time. So my final thoughts on the Bollinger Band is that remove the association of overbought and oversold. It has use as a real-time probabilities metric, and I think it's really good at being able to identify, so I don't know why this is overlapping, but it's really good, I think, at being able to identify noteworthy events. For instance, if we see that a price is being if this statistically unlikely price movement occurred here, Well, that might make us want to investigate the stock, this ETF, to figure out why is this price movement like this? Is there something that I'm not aware of? Essentially, it's a red herring that lets you figure out, is that the right one? It's an indicator that there might be something going on with the stock that is worth looking into. But because the oversold and overbought ideology of the Bollinger Bands I don't think is very useful, I don't actually think the Bollinger Bands should be used for any kind of entry or exit positions, because again, we saw that even when you have statistically unlikely price movement, it really doesn't tell you that you should go short. It really just tells you that that current price movement is statistically unlikely, which is a benefit in and of itself. So that is the Bollinger Bands. I hope you have enjoyed this video. I plan on making more on indicators where we dig a little deeper into them, figure out what they are measuring, and how we might be able to improve them so that our portfolios can benefit. As always, thank you for watching. I'm Justin, and happy trading, guys.